5 days from now, a jobs report that prints under 100,000 could move your portfolio more than anything the Fed said all last week. Good morning. It's Sunday, August 2nd. I'm Nick Fertucci with Eleanor Whitfield and Marcus Brooks. No fourth chair today, just the three of us. Yesterday, we graded the REIT that was. Today, we're doing the opposite: the calendar, the earnings slate, and one theme that's most likely to actually move the tape between now and Friday's close.
Morning, Nick. And I'd say the calendar's loaded undersells it a little.
Morning and calling it now. This is a week where the story changes on us at least twice.
Before we get into any of that, quick word on the board, because there's nothing to score today, which is its own kind of update. Eleanor sits at 9 wins, 6 losses, on a 1-game losing streak. Marcus is 7-9, riding a 2-game win streak. Sarah's 0-1, Dave's 0-2, both still waiting on their numbers.
Nothing moves because nothing resolved. Small mercies.
Right, but 2 pending calls from last week both land inside this window, so keep them in your pocket. Marcus's tariff exemption call needs 30 days from Friday, so that's checkable by early September, not this week. But Sarah's is, she called Brent under $90 through next Friday, and next Friday is this Friday. That one settles on our watch.
Which means oil's not just today's story, it's graded homework.
Exactly. All right, the week. Let's start with the calendar because it's unusually clean this time. 2 data points bookend 5 trading days, and almost everything else hangs off them.
Monday morning and baction to Lehtame vids. It's been sitting right around the 50 line for months. Above it, the sector's expanding, below it, contracting, and manufacturing's been the soft spot in an otherwise strong economy all year. I want the new orders component specifically because that's the forward-looking piece, not the headline number.
And the other bookend?
Friday. Nonfarm payrolls, 8:30 Eastern. This is the one that actually matters this week, more than any single earnings report.
Give the audience the 2 numbers because they changed the story completely.
Below 100,000 jobs added, and you've got real evidence of labor market weakness. That's rate cut fuel, and after 3 hawkish descents last week, the market's starving for it. Above 150,000, and you've basically told the hawks on that committee they were right to dissent. Yields go back up, not down.
So it's not really a range, it's practically a binary.
For how the bond market trades Friday afternoon, pretty close to 1, yes.
I'd add the context that makes Friday scarier than a normal jobs. Friday, the 30 years already at its highest since 2007. The 10 years above 4.7 for the first time since last January. We're not starting from neutral. We're starting from a bond market that already flinched once this month.
And there's a Wednesday piece to this too, right? ISM Services lands the same morning as Disney and Eli Lilly's earnings.
It does. And it usually gets less attention than the manufacturing red, which is backwards. Services is close to 70% of the economy. If that number's soft alongside a soft ISAV manufacturing on Monday, you got 2 separate confirmations heading into Friday instead of 1, and the bar for a weak payrolls number to actually move yields gets a lot lower.
Which is the version of this week where everything lines up in one direction for once instead of the split verdict pattern we've had for a month straight.
Give me a level, not a vibe. Where does the 10-year need to be by Friday's close for you to say the Hawks won the week?
Above 4.8, and I think that's the new floor, not a spike. Under 4.6, and last week was the overreaction, not this week.
I'll take that number and use it myself later. Hold that thought.
Noted, we'll come back to it. Now the earnings slate, because this is genuinely one of the fuller weeks of the summer, and it starts almost immediately.
Monday after the close, Palantir. It's the marquee report of the week, and the numbers are enormous. The Street's modeling revenue around $1.81 billion, up 81% year over year, with earnings per share up something like 119%.
Those are extraordinary growth numbers.
They are, and here's why I don't think that's actually the story Monday night. Palantir trades at roughly 61 times sales. At that multiple, the beat almost doesn't matter. What matters is whether the guide is big enough to make 61 times feel survivable 12 months from now instead of insane.
And I think that's exactly the trap in how you're framing it. Big enough guide is doing a lot of work in that sentence. We just watched MetaGuide Lite and get punished 8% with a much seener multiple attached. If Palantir gives anything less than a blowout on both revenue and next quarter guidance, 61 times sales does not survive contact with a merely good number.
Merely good isn't what's priced. Nobody's modeling merely good into that stock.
Which is my point, not yours. That's a stock priced for perfection heading into a print in a market that just spent a week punishing anything short of it.
Tuesday is even busier on the industrial and consumer side. Caterpillar, Merck, McDonald's, and Pfizer before the bell, then AMD and Amgen after the close. Before we get to chips, I want 30 seconds on Caterpillar and McDonald's, because those two together are as close to a real economy check as this week gets.
Caterpillar's the one I'd watch closer. It's a genuine bellwether for global industrial activity, construction, mining, energy equipment. If their order backlog commentary is soft on the call, that's corroborating evidence for a weak ISM print, not just an earnings story in isolation.
And McDonald's is the consumer version of the same question. Are lower-income households still trading down, or has that stabilized? I don't think it's the headline of the week, but it's the kind of print that either backs up or undercuts everything else we're about to discuss.
Okay, now chips. Marcus, AMD's the one you keep circling back to.
Because it's the AI hardware trade's actual report card, not a proxy for it. Street's looking for revenue near $11.2 billion. Up 46%, non-GAAP earnings around $1.67, and everyone's going to be listening for updates on the MF4 150 and Helios chips specifically. That's the part of AMD's business that's supposed to be NVIDIA's real competition, and so far it's mostly been a promise.
And this is where I'd actually connect back to last week instead of treating this as a fresh story. The memory chip complex spent 5 days last week cracking and healing in front of us. SanDisk reports this week too, down 53% from its highs, and the whole market wants a NAND pricing signal out of it. If AMD's guide is strong but SanDisk's read is soft, that's the supply side of the story still fragile, even while the demand side looks fine.
That's the thread from Saturday's show, basically continuing live in real time.
It never actually stopped. We just took a day off from talking about it.
Give me the actual number you're watching in AMD's print, not just strong guide.
Data center segment revenue growth, specifically if that's accelerating quarter over quarter instead of just growing, that's the tell the MF450 ramp is real demand and not a rounding error next to NVIDIA. Flat or decelerating data center growth, even with a beat on the total number, and I think the market treats it as more of the same promise we've been hearing for 2 years.
Fair. Wednesday, Disney and Eli Lilly report before the open. Disney's less about AI capex and more a straight read on the consumer parks attendance, streaming subscriber trends, and how much of that is holding up under everything else we've been describing this morning.
I'd watch streaming margins more than subscriber count, honestly. The market stopped rewarding pure subscriber growth across the sector. Netflix taught everyone that lesson 2 years ago. Profitability per user is the number that actually moves the stock now.
And Thursday, it's ConocoPhillips, oil earnings again, which loops us right back to where we're headed next. But first, Eleanor, you asked me to hold a thought a minute ago.
I did. Marcus gave me a 10-year level for the Hawks winning the week, above 4.8. I'll use that same test on his side of this argument. If the 10 years above 4.8 Friday afternoon and Palantir or AMD still closes the week green despite it, that tells me high multiple growth stocks have genuinely decoupled from the rate story, and I'd have to admit that's a real regime shift, not just a good week for two companies.
And if it's below 4.6 with both of those stocks up, I don't think that proves anything. That's just a good week and a good market, no decoupling required.
So you two actually agree on the test. You just disagree on what result would surprise you.
That's actually a fair way to put it.
Yeah, I'll live with that framing.
I'm going to leave that one right there rather than force a resolution because we won't know until Friday afternoon which of you gets to be right. Now, the theme underneath all of it, because I don't think this week's biggest risk is a print at all. It's a strait.
The Strait of Hormuz. And it's worth saying, ConocoPhillips reporting Thursday means we'll get a fourth oil majors read on this in the same week, right on top of Exxon and Chevron holding their CapEx guidance from Friday. WTI crude closed out the weekend near $84 a barrel, on pace for its biggest monthly gain since March, up roughly a fifth just in July.
And the news over the weekend specifically?
Iran stopped and turned back several tankers trying to exit the strait. And there was a drone strike on vessels at an Egyptian port on the Mediterranean earlier in the week. Worth remembering the scale here for anyone who thinks this is a regional story. Something like 1/5 of the entire world's seaborne oil moves through that one choke point.
And I'd put the other side of it on the table because it's real too. Tanker tracking data midweek actually showed cargo still finding ways through, even during the worst of it. Geopolitical oil spikes historically fade once shipping data proves supply isn't actually cut off. That's still the more likely path here. It's just not confirmed yet.
So which is it? Is the market actually pulled in two directions, the way that Reed suggests, or is one side just louder right now?
Genuinely both directions, and I don't think that's a cop-out. You've got a real earnings season underneath all this that's mostly been strong, and a shipping choke point story with actual military strikes behind it, not just rhetoric running at the same time. Those don't cancel out. They just make the tape harder to read than a simple risk-on or risk-off week.
This is exactly the setup behind Sarah's pending call. Brent under $90 through this Friday. Where does that sit given what we just described?
On the edge, honestly. WT, I near 84 puts Brent somewhere in the high 80s most likely, so she's not broken yet. But Iran turned back tankers this weekend is not the direction her call needs things to move.
Give it a beat before you bury her. 2 green shipping days undid a lot of panic 2 weeks ago. It can do it again.
And there's a second layer to this that Sarah flagged Friday and Saturday both. The 60-country tariff wave landing on top of an oil market that's already this jumpy.
Which is exactly my worry, and it's the same one from Saturday's show. I'm watching core inflation prints over the next month or two for tariff-exposed goods accelerating. If oil stays elevated on top of that, at the same time the Fed's just shown it has 3 genuine hawks in the room, that's not 2 separate risks anymore. That's one input cost story with 2 different sources feeding it.
And my counter is the same as Saturday's too. Futures went green the same morning all 60 tariffs landed. Markets aren't pricing an inflation shock right now. They're pricing an opening offer that gets negotiated down. I still think that's the more likely read.
One thing that actually might settle this faster than either of you expect, Kashgari. He's not usually the hawk in the room, and he voted to hike last week anyway. If he's out saying anything public this week about tariff pass-through specifically, that tells us which red he's leaning toward, and he's about as close to a swing vote as this committee has right now.
That's a good watch item, actually. He moved because the data moved him last time, not ideology. If he's worried about tariff stacking on top of what he already saw, that's the loudest confirmation my case could get without waiting for the actual print.
Genuinely unresolved, same as yesterday, and I'm not going to manufacture an ending for it. Quick gut check before we move on. Gold pulled back to around 40.40 an ounce after a big run, and crypto's oddly calm in the middle of all this. Bitcoin's holding near 63,000, Ethereum near 1870, both sitting inside tight technical ranges.
Which tells you something on its own. When Bitcoin isn't reacting to an oil spike and a hawkish Fed in the same week, that's a market waiting for its own catalyst, not one that's scared. Watch whether it clears resistance or slips back toward that 59 to 61,000 support zone. That's the tell either way.
I'd read the gold pullback the same way, actually. Not as risk appetite coming back, but as a market that already priced a lot of this Middle East premium in and is waiting to see if it's justified before it pays any more for it. 4,040 is still elevated historically, it's just off the recent peak.
So neither Marcus actually calling the outcome yet. They're both just waiting on the same week we are. One more thing worth saying out loud, because it's true every year and gets forgotten every year. August and September are historically the 2 weakest months for stocks. Doesn't mean anything specific happens. Just worth having in the back of your head under everything else we just laid out.
It's a seasonal pattern, not a forecast. But seasonal patterns on top of a genuinely tense setup are worth at least a raised eyebrow.
Before we close it out, how's everyone actually doing? Because this was a 5-day week that felt like 10, and now we're back at it on a Sunday.
Honestly, I slept in. First time in 2 weeks.
I did not. The program doesn't recognize Sundays either, in case anyone was wondering how week 3's going.
We asked yesterday, we're asking again today. This is officially a running bit now.
It was always going to be a running bit. I just didn't say so at the time.
All right, let's take it home. Closing calls. Not for tomorrow this time, for the week. Give me something checkable by Friday's close. Eleanor, you first.
Mine's the one I already laid out with Marcus, made concrete. If Friday's payrolls print above 150,000 and the 10-year closes the week above 4.8%, I think this hawkish repricing is the new floor under the market, not a spike we bounce back from. Under 100,000 jobs and a 10-year back below 4.6, and I'll say last week was the overreaction, not the turn.
And Marcus?
Mine's on the AI hardware trade specifically, not the whole market. If AMD's Tuesday guidance points to accelerating data center GPU revenue in the second half, and the stock's still up on the week despite the multiple everyone's nervous about, that tells you the healing we saw in chips Thursday and Friday was real, not a two-day bounce. If AMD guides soft and the stock's down on the week, I'm wrong and the fragile read wins.
2 calls, 1 common thread. Both of you are really asking the same question different ways. Did last week's hawkish turn actually change what the market's willing to pay for growth, or didn't it? We'll know a lot more by Friday afternoon than we do right now. Here's the week in one breath. ISM Manufacturing Monday, Palantir Monday night at 61 times sales, a 5 report Tuesday capped by AMD, Disney, and Eli Lilly Wednesday, ConocoPhillips Thursday, and Friday's jobs report deciding whether the bond market's hawkish turn was real. Underneath all of it, a Strait of Hormuz that's still not settled and a tariff list still working its way into the data. Watch the 10-year, watch AMD's guide, and watch whether Brent can stay under 90 through Friday for Sarah's sake as much as anyone's. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts and catch our daily charts and reels on Instagram at NovaVentures_US. That's your Sunday setup. Have a good rest of your weekend, and we'll see you tomorrow morning.